Okay, right. So let's move on to section B. Okay. Now let me tell you something about the exam, right? Section A. Okay, section A. There is a chance that you can go wrong, right? Because it tends to be slightly tricky. Okay. Section B, it is kind of tricky, but you can get a lot of, a time advantage from section B, right? Because although each question is worth 10 marks, I don't think anybody will need about 10 into 1.8, no? So I don't think anybody will take about 18 to 20 minutes just to do section B. Okay. Now section C, on the other hand, it's easier, comparatively easier than A and B. Why? Because all your workings examiner can see. Okay, so even if you go wrong here and there, it's fine. There are chances for you to get marks, right? But in terms of time, it will take a lot more time to do section C. And section A also, if it is a calculation, then definitely it's not going to finish off soon. Although it's only for 2 marks, it will take a lot longer. So usually B is where you get the time advantage. Okay, so make sure you know that, right? So for example, there is a big scenario, 2 calculations and 3 theory questions, means 3 theory is usually very simple for section B. It will be based on that scenario, so it tends to be simple. So you tend to get the time that you are losing out in A and C, you tend to get it in B. Okay, right. So let's continue. Right, so they are talking about a company called Gemford Enterprises. Okay, now it's made very easy for you in your exam. You have the question on one side, the scenario on one side, and whatever they are asking you on the other side, so you don't have to go back and forth and all of that. Okay, and you can highlight, right? I'm not able to highlight now, let me just check. Yeah, but again, if you use a laptop, you will be able to highlight. Okay, right. So what does it say? It's a good idea before you read the requirement, before you read the scenario, to read all the requirements first. Okay, so let's do that. First one, they're saying determine the economic order quantity for the component A prior to considering a quantity discount. So asking for a EOQ. Then the next requirement is what's the financial consequence of getting a 2% quantity discount. So something to do with accounting for materials, clearly. Okay. Then about just in time. Then again something theory about EOQ and something to do with early offering a discount. Okay, fine. So let's read through. Okay. Okay. So it says here, Gemford Enterprise specializes in manufacturing electronic gadgets. Due to previous challenges with suppliers' timeliness, Gemford has maintained a significant inventory of electronic components to ensure uninterrupted production. Okay. However, with recent improvements in supply reliability, Gemford is reassessing its inventory management strategies and recalculating the economic order quantities. One component, labeled component A, incurs a purchase cost of 1000 per unit for Gemford. The expected annual usage of the component A is 65,000 units. Usage means demand. Okay. Gemford incurs procurement costs including order placement and processing amounting to 2,500 per order. Furthermore, the holding cost of 1 unit of component A for 1 year is estimated at 30% of the inventory value. Fine. Then they are talking about a discount. Okay, they are saying notably, Gemford supplier offers a 2% discount on the price of component A if an order quantity of 2000 or more is placed. Okay, but this paragraph I don't have to consider now itself, because in this requirement they are telling me to ignore that. They are asking for the EOQ before the discount, so I can ignore the discount portion. Then it's saying also one of the directors at Gemford has proposed exploring the implementation of the just-in-time procurement strategy for sourcing component A. So somebody is suggesting JIT. Okay, fine. So what do we need to use to get EOQ? Basically just these 2 paragraphs. That's all we need. Okay, so I'll give you 2 minutes. I'm sure you know how to do EOQ, simplest calculation. Go ahead and get the EOQ. Okay, to the nearest whole number. So don't make a mistake and give it in decimals and stuff. Okay. Okay, so EOQ formula is given. I think it's the first formula in your sheet. Yeah, EOQ is there. Okay, right, so let me quickly get the answer. So I'm talking about EOQ. So that is 2 times cost of ordering demand divided by the cost of holding, right? So let's put in the numbers one by one. Cost of ordering. So they are saying Gemford incurs procurement costs including order placement and processing amounting to 2,500 per order. That is only clearly the cost of ordering. Okay, so 2,500 into annual demand, right? So what is that? They are saying the expected annual usage of this component is 65,000 units. So that is only the demand. It's already annual, so no need to do any multiplication. And the cost of holding, they said furthermore the holding cost for 1 unit for 1 year is 30% of the inventory value. Purchase cost is 1,000, so 30% of 1,000 basically. Okay, that should give you the EOQ 1040.83, but they told me to the nearest whole number. Even if you put the answer as 1040, it will be marked wrong. Okay, so nearest whole number means you have to round it up, 1041. Okay, right. Now they are saying what is the financial consequence of accepting a 2% quantity discount. Okay, so I have said this before, right? Now EOQ, if there are no discounts, we don't have to think twice. That is the quantity which minimizes your total cost. EOQ is the quantity that makes your cost minimum. So you don't have to think anything. You will go and order the EOQ 1041 units and call it a day, right? But the moment a discount comes into the picture, sometimes there is a chance that the quantity at which you are getting the discount will give you a lower total cost. So then what you have to do, you have to calculate the total cost incurred at the EOQ plus the total cost incurred at the discounted quantity, and then figure out whether or not the discount is good for you or not. Okay, so that's what we will do now. So I'll give you the structure. Usually this is how we do it. So total cost when ordering at the EOQ, which was 1041. Okay, so when it comes to materials, there are 3 costs that we have to consider. One is the purchase cost, then the ordering cost, and the holding cost. Each of them have a particular equation, right? So purchase cost is the purchase price into the demand. This is cost of ordering into demand over the quantity ordered. This is cost of holding into quantity ordered over 2. Okay, so now we need to do the purchase cost, ordering, holding for the EOQ quantity first, right? So the purchase price, I think it was $1,000, right? The question told me every unit was $1,000, so 1,000 into the demand was 65,000. So purchase cost will be 65 million. Okay, cost of ordering 1 unit was 2,500. Demand is 65,000. Quantity we are talking about the EOQ this time, so that's 1041. That's 156,100. Okay, Then we have the cost of holding. They told me it was 30% of the purchase price 1000 into quantity is 1041 over 2. Usually at the EOQ, the ordering and holding will be equal to each other. Here there is a small discrepancy, right? It's 156, 150. The reason for that is because this 1041 is a rounded figure. If you use the exact figure 1040.83, then both ordering and holding will be equal. Here because we are using the rounded figure only, it's not equal. Doesn't matter because in the question they told us to round it. Okay. Right, so let's get the total cost. So add up these three. Okay. So that should give me 65,312,250. Okay. So that's the total cost when we order at the EOQ, right? Now same thing you have to repeat for the discounted quantity. Okay. So take this down and try the discounted quantity as well. So total cost, then ordering at discount. So discount was 2% and the quantity was, I think it was 2000. Let me check.
10% means
2000 units or more means you get a quantity discount. Okay, so Q is 2000. Okay, take it down and then try to get the total cost with discount. Okay, so same thing, I will also start it off. Three costs: the purchase cost, the ordering cost, and finally the holding cost. Equations are the same: P into D, cost of ordering to demand over quantity, okay, and cost of holding into quantity over 2. Right, so price, now here there is a small change in the price, right, because we are going to get a discount. So it's not going to be 1000 anymore, it will be 2% less than 1000. So 1000 into 2% less, so 100 minus 2, 98%. Into demand is the same, 65,000. So that will be 63,700,000 we are talking about. Okay. Cost of ordering is the same, 2500 into demand is 65,000. Quantity is 2000 this time. That will be 81,250. Cost of holding is going to be 30% again into 1000 into 98% into quantity is 2000 over 2. So 1000 into 30% into that will be 294,000. So total cost at 2000 units will be at the 3, which is 64,75,250. Okay. Now compare these two. Okay, so this with this. So you can see if you order the EOQ, it will cost you 65 million. If you order at the discounted quantity, it will cost you 64 million. So if you order the discounted quantity, you are going to make a savings. Okay, so I will mention that as well. Okay, I don't know how that just disappeared. That's weird. Okay, I'll just put in the calculations quickly, okay, because in case you didn't get it.
So as you see on the screen, these are the 4 factors.
Purchase, ordering, holding. It's P into D. Cost of ordering into demand over quantity. Okay, so that will be 1000 to 65. Okay, to the totals also quickly. The total is 64. Okay, so there will be a savings. It will be 65, this figure. 65 312 250 minus 64 75 250. So a savings of 1,237,000. $1,237,000. Okay, so you will have to check here a benefit of 1,237,000 per year. Okay, right, so that is this. Okay, right, so last 3 was actually based on theory, right? So you can relax and just answer it, right? So it says here, in the context of procurement strategies, which of the following statements regarding JIT is true? A is saying JIT involves maintaining large inventories to ensure uninterrupted production. That's wrong. JIT means we will order the inventory itself only after the customer has placed the order. So we don't have inventory. That's wrong. JIT aims to procure goods from customers at the earliest possible time. That is also wrong, right? We wait until the last minute and then only place the order. JIT reduces dependence on suppliers for quality assurance and on-time delivery. Wrong. If you're doing JIT, your supplier has to be of, a person who gives you the goods on time plus with good quality. It shouldn't be a situation where, you place the order, he takes a long time to send it. After you get it, the quality is not good, so you send it back. If it's that kind of a situation, it won't work with JIT because already we are placing the order at the last minute, right? D is saying JIT implementation results in decreased inventory holding cost. That is correct. Why? Because we are not going to hold inventory in our warehouse at all. Only after the order is placed, we are going to go ahead and place the order for inventory. So where are we holding it at all? Right? So we don't have to incur any amount with regard to holding costs. So answer there is D. Which of the following assumptions are necessary for the application of the EOQ model? Okay, so you know the EOQ formula, right? It's 2 times cost of ordering into demand over cost of holding. So basically cost of ordering has to be constant, demand has to be constant, cost of holding has to be constant. Then only we can use the EOQ model, right? So what does it say? Demand is known and remains constant. True. Okay. Lead time, meaning the time between placing an order and receiving it, is going to be constant. That is also true. When it comes to EOQ, the lead time also has to be constant. If the lead time is not constant, EOQ does not hold true. Okay. C is saying ordering cost for each order and holding cost per unit per annum is known and it remains constant. Correct. Part of our equation. So A, B and C. Okay, so answer there will be A. Let's read D and E as well. Replenishment costs are unknown. That's wrong. We know how much it is, right? How much we will have to pay to buy a new unit. Unit costs of item changes when the quantity ordered? No. Okay. If the unit cost changes in case there is a discount or something, EOQ does not give you the, for sure it will not give you the cost that is minimized. Okay. So E is also not the case. A, B and C. So answer there is the first one. Which of the following are benefits of a company offering a discount to customers for early payment of invoices? So what will we get as a company? What's the benefit for us if we give our customers a discount for early payment? Okay. So better liquidity for the firm, definitely. Yeah. Why? Because they will pay quickly. So we get cash to hand quickly. So that's fine. Less interest as less or no overdraft will be required. That is also true because the customer is paying me money now. So why will I want to go to the bank and take a loan and pay an overdraft? I don't need it. Why? Because I have the money that I need. The customer has itself paid it, right? So that is also correct. Risk of more irrecoverable debts as customers take longer to pay. That's wrong. Okay, because they are paying early. The earlier they pay us, the risk of irrecoverable debts is actually lower. Okay. 4 is saying loss of customers who do not take advantage of the discount. Not necessarily. If they don't want the discount, they will not pay early. They will pay late. They are not going to say, no, I am not going to do business with you. No. Okay, so that is also not the case. So the answer will be 1 and 2. Okay. Right. So that is it for the first MTQ. Right. So now we look at this company called Sunrise Enterprises. Okay. Read the requirements first. Saying determine the base equity value for Horizon Industries using the net realizable value basis. Fine. Okay. Then they are talking about something to do with the price earnings method. Then they are talking about something to do with valuation again, but this is not a calculation. Then something to do with behavioral finance and something to do with looks like something to do with again behavioral finance only. Okay, right. So let's look at the question. Okay, can you have a quick read through so I don't have to go through it again and again? Okay, so it says here Sunrise Enterprises is contemplating making an offer to acquire Horizon Industries. So they are thinking of buying this company called Horizon Industries. It is expected that upon completion of the acquisition, the current management team of Horizon will retire, paving the way for new leadership. This transition is forecasted to generate a pre-tax salary cost savings of 30,000 per year. Fine. Then it's saying since Horizon is not publicly listed, a published price to earnings ratio for the company is unavailable. So we don't have a PE ratio. However, Radiant Innovations, a comparable entity to Horizon, currently boasts a PE ratio of 9. So we can use 9 as a substitute because we don't have the PE ratio for the company in hand. Okay. The statement of financial position of Horizon Industries as at 31st December is as follows. You have non-current assets, current assets, inventory, receivables, cash. Then we have ordinary shares, reserves, loan notes and payables. Fine. Additional details regarding Horizon Industries are as follows. They are saying the non-current assets, that is worth 150 million, have not undergone revaluation for several years, and it is estimated that their current replacement value is 300,000. So they are saying it's not going to be 150,000 anymore, it's actually going to be 300,000. They haven't revalued it, right? Then they are saying $10,000 worth of inventory is considered obsolete and it could be sold for 1,000. So the inventory that we have currently is 35,000, but in that 10,000 is obsolete, meaning we can't use it. So we have inventory worth 25,000, but that obsolete inventory you can sell it for a scrap value of $1,000. So that is an option that we have. So we have to make an adjustment for that inventory figure. Okay. Then they are saying the earnings per share amounted to 85 cents with a corresponding dividend per share of 45 cents, and they are saying corp tax rate is 30%. Okay. Right. So the first requirement is determine the base equity value for Horizon Industries using the net realizable value basis. Okay. Now if you are going to value a business, there are three methods. Either you go for the asset based valuation, an income or earnings based valuation, and a cash flow based valuation. Okay. So in this case, if you are saying net realizable value, we are talking about an asset based valuation. So you have to take all your assets and deduct your liabilities. That's a simple thing that you have to do here. Okay. Right. So let me quickly do that. So the assets that we have over here, non-current assets, inventories, receivables and cash. Okay. Now non-current assets, although in the books it says 150, they told me very clearly that it should be 300,000. Okay. So I can't take 150. I will take 300,000. I'll just mention it. Okay. Then inventory, if you look at the question, okay, so inventory, if you look at the question, it's 35,000, but in that 10,000 they said is obsolete, and that 10,000 you can sell it for 1,000, right? So 35,000 minus 10,000 because it's obsolete, but still it's not entirely lost. 1,000 you can recover. Okay, so actually inventory will be 25 plus 1, 26,000. Okay, what else? You have receivables and cash as well. How much were the receivables? Okay, I can't move up, it's fine. Receivables were actually in the question 20,000 directly given. Cash was 2,000. So total assets is 300,000 plus 26,000 plus 20,000 plus 2,000, which is 348,000. So to that you need to deduct the liabilities. So there was non-current liabilities and there was a payables. Non-current liabilities was this loan notes of 80,000 and payables is 18,000. So 80,000, 18,000. This would be the net realizable value. Okay, very simple. So you can put that here, 250. Don't put commas, okay, at your exam. Just put the number as it is. Right. Now it says, based on the most recent earnings per share, what is the equity value using the PE ratio method? Okay. Now, if you are using the PE ratio method, there is an equation to get the market value of the company, right? They are asking for the equity value, no? So, how do we get it? There is an equation. So, market value equals to the PE ratio multiplied by the total earnings of the company. Okay. Now, if you look at the question, they are telling me that the PE ratio of 9 can be used. So, I can just use that 9, no problem. Okay. How do I get the earnings? So, they told me something about earnings per share, right? They said it's 85 cents per share. Okay. So, if I want to know the total earnings, 85 cents into the number of shares will give me the total earnings. So, how many shares do I have in issue? It was a book value of 25,000 and the nominal value is 0.25. So, 25,000 divided by 0.25 will give me the number of shares in issue. Okay. So, I will get that figure. 9 into earnings per share was, they told me, 0.85 into number of shares. So, that is 25,000 divided by 0.25. That will give me the market value, which is 765,000. Simple calculation. Okay, so this has to be total earnings. So that is why I am multiplying it by the number of shares, right? So this is the number of shares. Okay, so this will be 765,000, which is B. Which valuation method would be advisable for Sunrise Enterprises if their intention is to purchase Horizon Industries and subsequently dispose the assets individually? Okay, now I told you there are three methods, either asset based, income based, or income or earnings based, or cash flow based. Okay, now the first one they are talking about, the dividend valuation model. This is used if you know you are going to use that company's income. Okay, so you are going to purchase the company with the intention of using its income. So if you are going to have that intention, using DVM is good. But here we are not keeping that intention. We are buying the company with the intention of selling the assets off. We don't want to run the business, right? So DVM is not a good option. NRV, net realizable value, is an asset based valuation method, right? Remember, if you are going to buy a company just to sell its assets and not to run the company, then the best valuation method will be an asset based valuation. So in this case, NRV is the best one that we have. PE ratio, if you look, again it is used only if you are going to acquire a majority shareholding and you have the intention of running the business. In this case, again, we are not running, right? So the only option that is suitable here is the net realizable value method. We call this asset stripping, if you remember. Okay, you buy a business just to sell off the assets and that's about it. We don't want to run the business. Okay, right. Then it says, Horizon Industries finance manager believes that their actions will directly cause an increase in earnings and a corresponding rise in the firm's share price. Which behavioral finance concept does this belief exemplify? Okay, so basically a concept where people within the organization are saying whatever we do is only correct. Okay, when whatever we do, whatever decisions we take will cause the share price to increase. If you can't remember this is actually part of the study hub. Okay, it's called behavioral finance. Just have a look at it quickly, because since they have mentioned it in the pre-mock, there is a chance that they might ask you to explain something about it, right? So take note of this particular area. It should come in one of the first few chapters. Okay, chapter 1 or chapter 2. Just read through it and make sure you have an idea of behavioral finance, right? So this kind of a situation where we feel that we are doing the right thing, we call that illusion of control. Okay, so there is no way you would know this unless you have read that part of the study hub. Okay, right. Then it says, which irrational behavior of investors involves following the crowd, often leading to stock market bubbles, right? Now this happens by, some people do this, right? What they do is, they don't take a decision of their own head. Okay, so they don't take a decision based on their understanding and their intelligence. What they do is, they will follow somebody else's actions. So like, they keep an eye on a few investors, maybe the major ones, and if the major ones are selling shares, these people also sell. If they are buying shares, these people also buy. So basically we are kind of following somebody else, right? So what is that actually called? It's called herding. Herding, if you can think about it, it's like, say a herd of cows. Cows are not going to think whether, okay, this is the correct direction. No. Whatever the one in front is doing, the one behind will also do, right? So same thing here. Whatever another investor is doing, these people also do. They don't necessarily take their own decisions. So this is called herding. Okay. So again, this is all part of the study hub. Please do have a read through, because usually they don't ask, but since this is part of pre-mock, I have a feeling in section C, they might have a little bit to do with theory with regard to this area. Okay, right. So that's it for Sunrise Enterprises. Now we move on to the last section B question. So we have section C after this. It's about Velco company, and this is entirely to do with risk management very clearly. Okay, how do I know? Because I can see a lot of exchange rates. Okay, right. So quickly read through it, and we can start. Okay, so it says here, Velco company, a UK based company, anticipates a receipt of $240,000 in 1 month's time, followed by a payment of $140,000 at the same time. So you are going to get 240. We are based in the UK. We are going to get dollars, so we are going to get foreign currency of 240, and we have to pay also $140. Okay, so whatever hedging we are going to do, we don't have to do for 240 separately, 140 separately. We can net it off first and do it for the remainder. Then it's saying it also expects receipts totaling 300,000 in 3 months time. So in 1 month time, the 240, 140 happens. In 3 months' time, the 300,000 happens. Finance manager has collected the following information: spot rate, 1 month forward rate, and the 3 months forward rate is given. Money market rates for Valco: 1 year sterling interest rate, borrowing deposit, and the dollar interest rate, both borrowing and deposit. So clearly, we might have to do a money market hedge. Okay. A is saying calculate the expected net sterling receipts in 1 month time using the forward market. So if we are going to hedge using the forward market, how much sterling pounds will we get? Okay. Right. So it's a forward, right? So let's see. We are going to receive 240,000. And at the same time we have to pay 100,000 or 140,000. Okay, so first let's net it off. Okay, so 240 minus 140, it's a net receipt of 100,000. So this 100,000 we are going to hedge using a forward. Right. So what are the rates that we have? So it's happening in 1 month. So 1 month forward rate is $2 to $2.5. So now we have to decide, is it the lower rate or the higher rate, right? So we are based in UK. If somebody comes and gives us dollars, we don't need the dollars. What will we do? We will sell the dollars, meaning the bank is going to buy from us. The bank always buys at the higher rate. Okay. So the two rates that we had was $2 and 2.5. They will always buy at the higher rate, which is $2.5. So 2.5 to the pound, right? So how many pounds will we get? Basically 100,000 divided by 2.5, which is 40,000 pounds we will get to hand. Okay. Right. So you need to put 40,000 here. Then they are saying calculate the expected sterling receipt in 3 months time using the forward market. So in 3 months time you are going to get a receipt of 300,000, right? So again what will happen? I will get the dollars, I don't want it, I will sell it, bank will buy high. But this time 3 month forward rate has to be used. So that will be 2.5 to 3. Bank buys high means we are going to convert at 3. Okay. So simply this is a 300,000 divided by 3. So we will end up getting 100,000 pounds. Simple question. Okay. So this will be 100,000. Oh, by the way, you can see, right? Currency signs, all of them are usually given in the question itself. So you won't have to put a pound sign or a dollar sign when it comes to the MCQs. Okay. Right. What will be the equivalent pound value of the expected receipts in 3 months time using a money market hedge? So this 300,000 receipt in 3 months time, they are asking you to do a money market hedge, a full money market hedge. Okay. So I'll give you 5 minutes. Can you please try it out? Everything that you need for a money market hedge is there. section 2. Correct. Okay, so let me also do the money market hedge quickly. It's a receipt of 300,000, right? So in 3 months time, what's going to happen? I am going to receive 300,000, meaning this is an asset. That means today what do I have to do? I have to do the opposite. I have to create a liability. So I can either borrow, I can deposit. Depositing means I am creating an asset. If you want a liability, you need to borrow. Okay, so borrowing dollars, what is the interest rate? 1 year dollar interest rate for borrowing is here 12%. Okay, so borrow at 12%, that's the 1 year rate. So I want only for 3 out of 12 months. Okay, so now I will get the present value, right? So today I will borrow the present value of 300,000. That is 300,000 divided by 1 plus the rate, right? So 12 into 3 over 2 means we are talking about 3%. So I will borrow 291,262. Okay, I have this in hand. 291, 262 I have in hand. I am UK based, I don't want dollars. So what will I do? I will sell the dollars. Bank buys from me. They always buy at the high rate. So whatever the spot rate is, you have to take the higher figure. So current spot rate is 1.8 and 2. So you take the higher rate, which is 2. Okay. So how much will that be? So in pounds, I will have 145,631 pounds. I have that in hand. Okay. So now what do? I will go and deposit this. So pounds, no, so get the deposit rate, right? So 1 year sterling deposit rate is 10%. So at 10%, but careful, into 3 over 12. Okay. So then finally, in 3 months, I will end up having in my account 145,631 plus the interest, right? So 1 plus 3 over 12 into 10% is, we're talking about 2.5%. Don't tell me it's gone. Possible. Okay, and just quickly do it quickly, okay, because in case you haven't copied it down, give me a minute, I'll just write it down again. Okay, so I will deposit this. So what I end up having is 145,631 times 1 plus 2.5%, which is 149,272. So yeah, the answer is B. Okay. That's how the money market hedge will look like. Okay. Right. So take it down if you haven't. Right. So 149,272 option 2. Right. They're saying what is the impact of a fall in a country's currency value. Okay, so if your currency value falls, will your exports be given a stimulus? Because export means what? Other people are going to buy from you, meaning foreigners are going to buy in your currency. Now if your currency becomes weaker, with their currency they can buy more goods from us. So yes, exports will be given a stimulus. Why? Because the buyer has more power in terms of currency. So if he can purchase more with a little bit of his currency, he will definitely be happy to purchase your goods. So exports will get a stimulus. Rate of inflation will increase. Yes, if your currency depreciates, we know that inflation will increase in that country. So both is correct. Both are correct, right? Which of the following characteristics is typically associated with the forward contract? They're saying they're exchange traded. Forwards can't be traded on an exchange. Futures can be traded. Forward is something where you go to the bank, you fix the rate, you come, you can't sell that rate to somebody else. Okay, so that's wrong. They involve standardized terms and conditions. Again, that's not a forward, that's a future where you have standardized terms and conditions. So definitely not that. A forward is tailor-made. Okay, so you can make it according to how you want. Okay. 3 is saying legal binding contracts which predetermine the rate for a future transaction. That's correct. If you go to the bank and fix a forward, you can't, after that 3 months later when the forward is supposed to happen, you can't, forget about it and not answer their calls. Okay. It is legally binding. If you go and agree, you have to honor that contract. Okay. So that's the answer. I'll just look at D. They are rights but not obligation to buy or sell. That is an option. Right and not an obligation is an option. It's not a forward. Right. So yeah, that is the answer C. Okay. So now let's start with section C. Okay. Alright. So what is it saying here? I hope it's clear to you if I type here. Just check. Okay, give me a minute. I think it's fine. A is saying calculate the net present value of the investment project and comment on its financial acceptability. Okay. So nothing to think of here. It's a normal NPV calculation. Okay. So what we will do is, let's quickly read through this. I'll give you a minute to read through it and then I will start off with the calculation. Okay. Okay, it's clear. If you are comfortable, you have the question, you can also do it. We have done so many NPVs at this point. Okay, so let me see what it says. Nexus PLC, a prominent player in the automobile industry, is in the process of planning to set up its own engine oil processing plant. The initial market survey incurred a cost of 25,000 and the investment is estimated to be 800,000. Now this initial market survey is a sunk cost. Okay, so in this situation always write that somewhere. Sometimes you get a mark for mentioning that. Okay, so say the initial market survey cost of $25,000 is not relevant to the calculation since it is a sunk cost. Okay, mention that. Okay, then they're saying the initial investment is 800,000. We have to use that. This new project life is expected to be 4 years and the company expects a scrap of 250,000 at the end of the project. Demand projections are as follows. So demand in year 1 is 2,000, then 4,000, 6,000, 8,000. Fine. Selling price is 100 and the variable cost is 30. Annual fixed cost is estimated at 100,000, which includes 60,000 depreciation and 10,000 of an apportioned headquarter cost. Again, depreciation and apportioned headquarter costs you can't consider. They are not relevant, right? It has to be future incremental cash flow. Depreciation is an accounting adjustment and apportioned overheads are also not relevant, right? So from the 100,000 you have to deduct 60,000 and 10,000. Okay, right. So let me set up the structure. Net present value, right? So let me start with the sales income. I have years not 1, 2, 3 and 4. So if you look at year 1, I know that the demand is 2,000 and the selling price was 100. So it will be 200,000. Then in year 2, the demand, they're telling me it's 4,000. Selling price is still 100. That's 400,000. Then in year 3, 6,000 into 100. Put the formulas because then even if you make a mistake, examiner can, give you the mark for your calculation. Okay. Then 8,000 demand into 100. 800,000, right? So that is the sales. Okay, then we have the variable cost. So here also they are telling me the variable cost is $30 per liter, right? So I'll put it as a negative figure. So 30 into 2,000. The demand, which is minus 60,000, then 30 into demand, which is 4,000, to 6,000 the demand into 8,000, which is 240,000, right? Then we have the fixed cost component. They're telling me it was 100,000, but you have to deduct the 60,000 and 10,000. So that will be 100,000. Okay, this you don't need the working because it's straightforward. So 100 minus 60, 40 minus 10, 30, right? So I'll just directly put it as 30,000 because I can copy it to all this. Okay, so that is the main part. Okay, so now you can underline this. And now here we take a total, we call it the operating cash flows. Okay, I'm just taking totals. Okay, so 110,000, 250,000, 390 and 530,000, right? Now from this only we will make adjustments for tax. Okay, so let's see what they are talking about the taxation. They are saying Nexus pays corporation tax at a rate of 33% and it's payable 1 year in arrears, right? So I can consider tax over here. So tax expense, it's going to be 33% but paid 1 year later. So 33% into 110 will happen in year 2. That is 36,300. Put as a negative figure. Then here it will be 33% into the previous year's figure, which is 82,500. This is 128,700, and in the last year, year 5, $174,900. So that's the taxes, right? Then they're saying, they're talking about working capital. They're saying working capital equivalent to 10% of annual sales is required at the start of each year and it's recovered at the end of the project. That's fine. Then they're saying cost of capital is 10% and they're talking about tax allowable depreciation. So I will quickly do that adjustment because I have finished off tax now. So I'll do tax allowable depreciation now. Okay. So they are saying you can claim tax allowable depreciation at 25% on a reducing balance basis. So let me do the tax allowable depreciation calculation. Call it working number 1. Okay. Right. So I have the years, year naught, there is a cash flow. How much is that? It's the initial investment. Initial investment is 800,000. Okay. Right. So on this initial investment in year 1, I will claim tax allowable depreciation at 25%. Okay. So 25% into 800,000, that will be 200,000. So minus 200,000. That will give me the written down value at the end of year 1, which is 600,000. Okay. Like that you have to keep on doing it for every year. Okay. So year 2 also I will claim tax allowable depreciation 25% of 600,000, which is 150,000. Okay. So written down value, that is going to be 450,000. Then in year 3 again I will claim tax allowable depreciation 25% into 450,000, that is 112,500. Again I get the written down value, which is 337,500. Now year 4, this is a 4-year project now. So year 4, what will happen? Scrap. So they are telling me the scrap value in the question. They told me it was 250,000. It's given here. Okay. So put that there, 250. Okay. And then you get a balancing allowance in this case, which is 87,500. Okay, so now we can determine our tax savings, right? So tax savings, how do we get this figure? It's always a multiplication of the tax allowable depreciation, right? So this into 33%, this into 33%, this figure 112,500 into 33, and the balancing allowance into 33. So our tax savings here will be 66,000, 49,500, 37,125, and finally here 28,875. Okay, finally you need to decide the timing. That's very important because everything is paid in arrears. This 66,000 you get it 1 year later. It's tax allowable depreciation for year 1, but it's actually the benefit you get the following year. So this is year 2, year 3, year 4 and year 5. Okay, so that is basically your tax allowable depreciation adjustment. Okay, right. So now I can put these figures into my main statement, right? So I'll call it tax allowable depreciation. I can call it tax relief from tax allowable depreciation, working number 1. Okay, so year 2 onwards only we will see the benefit, right? So I'll copy down those numbers. 66,000, then I had a 49,500, 37,000, 49,500, 37,125 and 28,875. Okay, right. So that's the tax relief from tax allowable depreciation. Okay, if you have any questions you can ask me. Okay, then finally we need to get the working capital cash flows. Okay, so let me do the working for that as well. I'll give you a second. If you want, quickly copy this working down. Okay, so what are they talking about? Working capital. They're saying working capital equivalent to 10% of annual sales is required at the end of at the start of each year and recovered after the project is completed. Okay, so what was my annual sales? I actually put it here now, so I'll copy that. 10% of this figure I need it same as working capital. Second, not sure this is connected. Okay, so sales volume is year 1, year 2, year 3, year 4. Okay, so working capital required I'm not sure why that's coming as. Okay, so I'll just put the heading here, working capital cash flows. This will be working number 2. Okay, right. So working capital that I require is actually 10%, they told me, right? So working capital required, it will be 10%. So 200,000 means of that 10% is going to be 20,000, right? So 10% of 200,000, 20,000, this will be 40,000 this will be 60,000, this will be 80,000. Okay, but we need it 1 year before, because they are telling me it has to be in place at the start of the year itself, right? So this working capital of 20,000, it should be available in year naught itself. So working capital cash flow, here itself that 20,000 should be available. Then for year 2 I need 40,000, but I have already put in 20,000 the previous year. So the increment of 20,000 only I have to put in year 1. So that will be 20,000. Then in year 3 also same. I need 60,000, but I have already put in 40,000. So the increase of 20,000 is what I need to put. And here also I need 80,000, but already I have put in 60,000. So again increment is 20,000. Then finally in year 4 they said everything will be released. So the entire 80,000 it will be released. Okay. So let me put these as negative figures because these are outflows. 80,000 is an inflow, right? So this whole thing you can take it to your statement. Okay. Right, so we have that as well. Now lastly, just take the let's just take the initial investment and scrap. Okay, so initial investment, that was 800,000, so minus 800,000, and scrap was I think 250,000, right? So 250. Okay, so that is that. So now you can take your cash flows, right? So let me take the total cash flow. Over here it will be minus 820,000. You also take the total. We already have this 110 is a total, right? So 90,000. Okay, so just taking totals here. Okay, so now what you can do is you can get the net present value. Okay, now there are two ways to do it. I'll do it the normal way that we do by taking the discount factor, but you can use the formula on the spreadsheet if you are comfortable. If you are not comfortable, then no problem, use the discount factor itself. Okay, so let me just bring this down a little. Can be a little difficult to do this on a tab, right? So one second. Always when you are doing this, use a laptop, okay? Because if you use a tab or a phone, you won't be able to use this spreadsheet properly. Right, so we have the cash flows. Take the discount factor. I think they told me, right, it was cost of capital is 10%. Okay, so just a matter of taking discount factor at 10%. Okay, so for year naught it will be 1. Okay, then 0.909. One second. Okay, so let me go to the 0.909, 0.826, 0.751, 0.683. I'll show you how to do it with the spreadsheet also. Okay, 0.826, 0.751, 0.683, and 0.621. Okay, so then multiply the figures, right? So present value I don't know. Let's put the figures, right? So this is 820,000. I don't know why it's not letting me formulate. Why is it? Okay, doesn't matter. I'll just put in the figures, okay, quickly. $81,810, and this will be 259,700 into 2 512 This is 253 087. Okay. Four to 5 into 0.683. 524834. You might, when you're using the practice platform, guys, you might find it a little laggy. Okay, don't worry, your exam won't be as bad. Like, I mean, I'm not saying it will be very bad. Okay, but when you're using the practice platform, now see, for example, now it's for some reason not letting me press the equal sign and choose two cells. Okay, now maybe if you use a laptop, that won't be a problem, right? But there will be small issues, but you won't be facing lagging and stuff at your exam. Okay, so don't worry about that. Which is 90,682. 90,682. It's a negative figure. Okay, so now you can get NPV. It's not letting me formulate. Okay, so I'll get the total, okay, of the present values. It will be something close to, give me the figure, 163,840. Okay, 116,840. So it took a lot longer than what it should, because suddenly it's not properly letting me formulate, right? But otherwise this is something you should be able to quickly finish off. Okay, So I'm not sure if I can show you. There is a method to get NPV using the spreadsheet alone. Okay, so let me show you that also quickly. I think I have showed before. It goes like this: equal sign NPV. You have to open a bracket and select. Okay, see, it's not allowing me to do it here. Okay, so just have a look at this. How it works is like this, right? Equal sign. You have to put NPV, open a bracket, and select all your cash flows other than the initial investment. So don't select the initial investment. Select 90,000, 259, 337, 768, 146. All of them you have to select and press the equal sign. That will give you an answer. No. From that answer, you have to deduct the initial investment. That will give you NPV. Okay, so that's how you use the spreadsheet function to calculate NPV. It's a lot faster, but if you're comfortable with this, it's fine, because it will only take maybe 1 minute extra. Okay, but see, if there is a problem formulating and all of that, then yeah, it will take much longer. So in that case, it's better to use the spreadsheet method itself. Okay, right, so that's the NPV. So it is positive. You have to accept the project. Mention that, you get a mark. Okay, so since NPV is positive, the project should be accepted. Okay, so just mention that. Right, that's it. You get your 12 marks. Okay, easy, 12 marks. So that is your table. By the way, guys, the answers to the pre-mark, it is available. Okay, so it is available. If you want to access it, it is there in the practice platform itself. Okay, right, so let's move on to the next one. I didn't expect that to take so long. It took long only because I couldn't do the formulation on the sheet. Okay, if not, it's usually much faster. Right, we might have to go on till a little later. Okay, today we'll finish off the paper. Right, B is saying discuss two differences between NPV and IRR. Also, in the context of mutually exclusive projects, discuss which method is preferable. Okay, so they are asking you two differences between NPV and IRR, and if you are having mutually exclusive projects, which one is preferable. So 5 marks, better to get 5 points. Okay, C is saying comment on the financial manager's preference to NPV for investment appraisal. So if you look at the last point, it says the CFO suggests that using NPV for investment appraisal, he is suggesting using NPV, emphasizing the method's alignment with long-term objectives. However, some finance managers express concerns as their performance evaluations and compensations are more tied to annual profits. Okay, so I'll show you the answer that they are expecting here. Okay. Okay, so how do you know, go and get the answers? It's in a tab called mark. Okay, so under self marking, you should have the December mark. Only after you try the paper, they will give you access to it, right? So I'll quickly finish off this paper, so I will get access to the marking scheme. Okay, so just give me a second. Okay, so only when you press on the left hand side end exam, it says are you sure you want to end it, you have to say yes. Only then the marks will be, the marking scheme will get available to you here. You can see now when I go to mark, I have pre-December. Okay, so now you can self mark if you want. So just to show you the answer to that question. Okay. So let me go to that particular question. It was yeah. So you can see question sample answer, right? Click on that. Right. So these are the differences between NPV and IRR, what they are trying to say, right? So it says here, first thing, NPV looks at absolute increases in wealth, and so it can be used to compare projects of different sizes, whereas IRR is looking at relative rates of return, so it ignores the size of investments, right? So if you look at the NPV answer, it comes as a dollar figure, whereas IRR is a percentage. So absolute figure means you can compare any sized investment, no problem. Whereas when it comes to a relative figure, we can't compare investments of different sizes. So that is one point that they're saying. Then they're saying NPV is not subject to technical difficulties which limit the usefulness of the IRR method. I have mentioned this before. If there is a project that doesn't have a conventional cash flow, meaning year naught there is an initial investment, after that every year there is a inflow. If you are not having that kind of a pattern, you will calculate multiple IRRs. So in NPV you don't have that problem, right? So IRR technical difficulties are there, right? So that's the second point that they're saying. Then it's saying the NPV of a proposed project, if calculated at an appropriate cost of capital, is equal to the increase in shareholder wealth that the project offers. So if the cost of capital is correct, then the NPV is basically how much the shareholder will earn from that particular project. In this way, NPV is directly linked to the assumed objective, which is maximization of shareholder wealth, whereas IRR calculates the rate of return. Although this can show the attractiveness to the project to shareholders, it does not give exactly how much their wealth is increasing by. Okay, so that is the other thing. NPV, they know by 163,000 my wealth will increase. IRR, they can't mention that. So it says here, finally one more thing, NPV, the accept and reject decision is very straightforward. If it is positive, accept. If it's negative, reject. Whereas IRR, you don't have a clear-cut decision rule. Okay. Then in that question they had asked about mutually exclusive projects, meaning you can only do one project, you can't do the other. If you do one project, you can't do another project, right? So in the situation of mutually exclusive projects, it's possible that IRR may rank the projects in a different order to NPV. IRR assumes that any net cash inflows generated during the life of the project will be reinvested in the IRR, whereas NPV assumes a reinvestment rate equal to cost of capital. Generally, NPV's assumed reinvestment rate is more realistic, so it ranks the project correctly. So what we are trying to say here is, if there is a mutually exclusive project, IRR gives one decision, NPV gives another decision, NPV's decision will always take superiority because NPV is a superior investment appraisal technique. Okay, so if you can mention those points, you will get your 5 marks. Okay, right. So that is the 5 marks there. Then they are saying comment on the finance manager's preference for NPV. Why does he prefer NPV compared to other methods? So he is saying for investment, saying that the method is aligned with long-term objectives. Okay, so let's see what they are saying here. It's saying NPV is based on the assumption to seek shareholder wealth maximization, whereas managers will prioritize profits because their compensation, their bonuses, all of them might be aligned with profits and not shareholder wealth maximization. So this can create a situation where managers focus on optimizing short-term results to reach performance targets, even if it means that long-term value is sacrificed, okay, as measured by the NPV. So managers' remuneration depends on the level of profit and not on the long-term return. Thus, managers may be unwilling to take risk on large expenditure on projects that only offers good long-term results. So, usually managers tend to not accept NPV. So, NPV happens to be a good option if you are thinking for the benefit of the shareholder. But if you are thinking for the benefit of the manager, if his compensation, if his salary, if his bonus is all going to be linked to profit only, then he might not be willing to use NPV as a investment appraisal technique. That's what they're trying to say here. Okay, so that should give you, I think, 3 marks. So you can just mention something that comes to your head at that time and call it a day. That's about it. Okay, right, so that's that. Let's quickly do the last one as well. Okay, so we need to go to 30. Okay, so they're saying evaluate if the bright path proposal is financially acceptable to Luminex Corporation. Okay, so there is something that they're talking about. I'll just read through the requirements. Okay, so that's A part. B is saying discuss the factors to consider in shaping the dividend policy of a public listed company in the stock exchange, and C is to explain any two Islamic financial instruments available to the business. So actually the B and C is very easy. Okay, right, so let's look at how to do the A part. That's the only calculation. Okay, can you quickly read through it? Clearly to do with working capital management, right? So again guys, next week it will be entirely online. We won't be having classes on site. We will be doing a mock exam. Okay, so it will be from 8:30, 9:30, 10:30 to 11:30, and email me your answer scripts. I will go through each of them individually and I will give you personalized feedback. So I will send you your marks together with what I think, where I feel you should improve via email itself. So please send me an email, and if possible send me a WhatsApp message also confirming that you sent. Okay, because there was, I think, one situation in the last mock where one person said they sent it but I didn't get it. Okay, so please make sure that if you send it, send me a message also, and wait until I reply to that message to confirm that I have seen your answer script.
Right, so now we will get
Okay, so what are they saying? Embarking on a journey to refine on its working capital management and to increase dividend payouts, Luminex Corp's financial manager is actively seeking strategies for improvement. Fine. Luminex Corp generates annual revenue from credit sales amounting to 36 million. So their revenue is 36 million. Despite requiring all credit customers to settle invoices within 30 days, customers often take longer. Roughly 0.5% of credit sales result in irrecoverable debts that remain outstanding and unrecovered. Fine. Then they're saying trade receivables currently stand at 5 million and Luminex Corp incurs a short-term finance cost of 8% per year. So if the receivables is 5 million, until the receivables pay me, I have to take a loan of 5 million and pay 8% on that loan. Okay. Considering a proposal from a factoring company. So problem seems to be the fact that we are not getting the money quickly, right? So factoring company Bright Path offered to manage its sales ledger on a with recourse basis. Fine. Bright Path aims to leverage its expertise to reduce average trade receivable days to 20 days while cutting irrecoverable debts by 80%. Okay, so what are they promising? They are saying currently people take 30 days. No, we will make them pay within 20 days, and you have irrecoverable debts of 0.5%, bad debts of 0.5%. They are saying we will reduce that by 80%. Okay, so currently you have 0.5% into 5 million. No, that figure we will reduce it by 80%. That's what they say. And they are also going to lower admin cost by 120,000 annually, because if you go for a factoring company, you don't need to have a credit control department internally. So which means what will happen? You will make a savings. Yes, Fatima, mock will start on Saturday at 8:30 a.m. Okay, I know that some of you might have problems doing it at that time and all of that. So I'm giving you a deadline. I'm talking about 30th of November, Saturday. Send me your answers before the end of that day. Okay, simple. I've made it very simple. Before the end of that day, meaning before basically 12 midnight on Sunday, send it to me, because I will be marking on Sunday. So if you send me your answer script on Sunday morning or Sunday evening, then there is a chance that I might not have time to mark it. Okay, so if you want proper feedback, please attempt it by Saturday and send it across. At 8:30 the Zoom meeting will start. Okay, so I will be there online, so in case you have questions and stuff, you can always ask. But if in case there is a chance that you are not able to do it at that time, before the end of the day I want the paper. Okay, right, so there is going to be an admin savings. As part of the factoring agreement, Bright Path would advance Luminex Corp 70% of the invoice value at an interest rate of 9% per year, and they charge a fee of 1.25 of the credit sales. Assume that there are 360 days in the year. Okay, so they are saying, is this proposal that Bright Corp, whatever they are proposing, is it financially acceptable or not? Let's see. Okay, so let's see the cost that we will incur if we are going to manage in-house. Okay, so in-house management. So what and all do we have to have, right? So what's going to happen if you are going to do in-house? First of all, that 5 million, that receivables figure, you will have to take as a loan. Okay, so we will have a short-term finance cost. Short-term finance cost. Okay, how much is this short-term finance cost? That is 5 million into, I know that it's a short-term finance cost of 8%, right? So 5 million into 8% I will have to incur. So that is how much? 400,000. First thing. Okay, then if I do it in-house, I will have irrecoverable debts of 0.5% of sales. So irrecoverable debts, that's going to be 0.5% into the sales figure, which is 36 million. So that is 180,000. This is another cost I will have to incur. Okay, what else? They said that if I go for factoring, I will save on admin cost of 120,000 annually. That means if I don't go for factoring, I will have to incur that 120,000. So that is only my administrative cost. Call it administration cost of 120,000. Okay, is there anything else? That's all I will have to incur. So total cost in-house, take a total here, 580, 680, 700,000. Okay, okay, Right, so now let's see the same thing if we are going to go for factoring. Okay, so let me call this. Okay, doesn't matter. Right, so factoring service. Right, so if you are going to go for factoring service, they are saying that they will give me, so you can see, considering a proposal from a factoring company, it's a with recourse basis, they are saying that they will reduce the receivables to 20 days while cutting irrecoverable debts by 80%, that's fine, and lower admin cost by 120, that's also fine. Then they are saying as part of the factoring, they will advance 70% of the invoice value at an interest rate of 9% per year. So that is the first cost, right? So factor finance cost. Okay. So if you look at the factor finance cost, they are telling me they are going to make it 20 days now. So the receivable days is going to become 20. So I can calculate the receivables using that, right? So the equation is this. Okay, so I know that this is the equation. So receivable days equals to receivables over sales into, they told me to use 360, right? So if the receivable days is going to become 20 days, then what will the receivables be? I need to calculate, right? Sales is 36 million into 360. Okay, so what is the receivables going to be? Let me check. Yeah, so receivables will be 2 million. Okay, so on this 2 million only, they are saying they are going to give me 70% in advance itself, right? So 70% of 2 million, and I will have to pay them an interest of 9%. Okay, so basically how much will the finance end up being, right? So that will be 36 million divided by 360 into 20 days, that will give me the 2 million. Of that I am going to get 70%. And on that 70% I need to pay 9% interest. So the finance that I will end up having to pay is 126,000. Okay, that's the factor finance cost. Okay, then they are telling me that they will charge a factor fee of 1.25% of credit sales. So I can put that easily, factor fee 1.25%. Credit sales was 36 million. Not 0.25, 1.25. Okay, so that will be 48,000. Sorry, not 48,000, 1 second. 450,000. What else do I have to consider? Right, let me check. Then they are saying irrecoverable debts, right? So irrecoverable debts, they are saying they will reduce it, right? So it was 36 into 0.5, but they will reduce it by 80%, means now it's going to be 36 into 0.5 into 20%, because they are reducing it by 80%, right? So irrecoverable debts, how much is that going to be? 36,000. Okay, so that is what they have given me straightforward, right? Nothing else they are mentioning no there. Yeah. So one last thing, it's not direct, it's a little indirect here, right? So if you see here, they are telling me this 2 million, that is 6 divided by 360 into 20, 2 million, only 70% they will give it to me in advance, right? Meaning the remaining 30%, I have to go to the bank and take a loan and, pay the normal overdraft rate. So normal overdraft rate for me is 8%, right? So for that remaining 30 million, I will have to incur that fee. So that is not straightly given in the question. You have to mention that. So I will call that finance cost on receivables balance. Okay, so that will be the same thing. I don't know why this is not getting copied. Okay, I'll type it again. So I'm talking about 36 million divided by 360 days into 20 days into the balance 30%, which I will have to pay 8%, right? So that will be 48,000. Okay. So that will be the total cost that I have to incur under the factoring service, right? So 126 plus 450 plus 36 plus 48. So total cost okay, so I'll just put the total over here, should be 660,000. Okay, so if you look at in-house, it's 700,000. If you look at the factoring arrangement, it is 660,000. So obviously factoring happens to be cheaper by 40,000. Okay, so you can mention that savings or you can put it as a sentence itself, a saving of 60,000, not 60, no 40, can be made if the company opts for the factoring arrangement. Therefore, the factoring arrangement is financially acceptable. Okay, so you just need to mention that. Right, so that will give you your 8 marks. Right, so let's move on to the next one. B and C were entirely to do with theory, right? Discuss factors to consider in shaping the dividend policy of a public listed company in the stock exchange. 6 marks. If you can make 3 explain points, that will be it. And C is saying to explain 2 financial instruments. So I'll just quickly show you the answers to that. Okay, so 34. Something is up with, I guess, because we are coming towards the end. Right, so they are asking what we need to consider if we are going to go for a dividend policy, right? So in this you can choose about 3 or 4, even if you can mention 5, it's fine, right? So first one is easy, sustainability of the business, right? So when you are deciding the dividend policy, what they are trying to say is make sure that if you are paying a particular dividend today, you can pay that into the future as well. So don't, settle for a figure that you can only pay this year and next year you won't be able to pay it, right? So that is the first thing, sustainability. Next is law. Sometimes according to your legislation, you might be allowed to pay only a particular amount of dividend. So if there is a legislation like that, that is going to definitely impact the dividend policy. Okay. Third, they are saying covenants. Covenants means if you have bank loans, there might be certain clauses which say you can't pay a dividend more than this percentage. If that's the case, then whether you like it or not, you can't pay more than that. So you have to make sure that you honor that as well. Liquidity, again, if the dividend is paid by cash, if you don't have cash, maybe you have profits, but if you don't have cash, don't waste time and try to raise that money and all of that. Stick to an amount that you have in hand which you can pay. So if you can make, say, now I've already spoken about 4, no, you would have easily got 6 points, 6 marks at this point. Okay. Then there is the signaling effect also. Like for example, if you are paying a constant dividend, suddenly the dividend is dropping, your clientele might think that the company is not doing well. Whereas in reality, the dividend reduced because you invested in positive NPV projects. So just mention that as well. Okay. So you can go through this just to give you an idea of what can be said. C was to talk about 2 Islamic financial instruments. So they are talking about Mudaraba and Murabaha. Okay, so it says here, a key principle is that charging interest and making money from money, lending a loan is forbidden under Sharia law. So providers of finance are more directly involved with the risk and rewards of the business. So you can choose any 2, right? Murabaha, Mudaraba, Sukuk, okay, what do you call that? Musharaka, anything is fine, whatever you are comfortable with, okay. So here they are talking about Mudaraba. It's a partnership where only one of the partners, we call the Rabul Mal, contributes capital, and the other person, the Mudarib, he contributes skill and expertise. Okay. So the person who gives capital, he does not interfere with the running of the business. But in case that there is, you can see here, due to the fact that one of the partners is running the business and other is solely providing capital, investor has to rely heavily on the Mudarib, his ability to manage the business and his honesty when it comes to sharing of a profit or loss. But actually there is more to this as well. In case there is a profit, there is a pre-shared ratio. Whereas if there is a loss in the Mudaraba contract, it is entirely borne by the Rabul Mal, the person who gives the investment. Okay. Then they are talking about Murabaha. This is something like a loan where you can see here it can be used for the purchase of goods for immediate delivery on deferred payment terms. Okay. As part of the contract between the buyer and the seller, the price of the goods, the markup, delivery date, future payment date, everything is agreed. Sale of the good is immediate, but the payment is done in installments. Okay. So you can explain. I have given you in detail how all of these work. So choose any 2 and you should be able to explain. But sometimes they will tell you explain Sukuk or explain Musharaka. So in that case, you can't go and explain Mudaraba obviously. So make sure you know all of them well. Okay. Right. So that is it. You should get the, how many marks there? 6 marks. Okay. So 3 points each. So you have to, it has to be well explained points. Okay. Right guys. So that is the end of the pre-mock. Okay. So ACCA has what we call debrief videos, but they don't look at the MCQs in detail. That's why I did the paper. But if you by any chance want to go through something, or you just want to have another perspective, everything is available here. No, you can expect the same difficulty. It won't be more difficult than this. Okay. Okay, Fatima. Fatima is asking, is the real exam going to be like this or will it be more difficult than this? I don't think it will be more difficult. Okay, it won't cover as many areas, but you should be comfortable with theory, you should be comfortable with calculations and so on. Section B and C is very similar to a normal exam. Section A in this pre-mock is a little it has covered a lot more areas than usual. The reason for that is because it's a mock exam. So they want you to, kind of get exposure to all those areas before you sit for the real paper. Right? Okay then, I will see you on next Saturday, 30th, online with a mock exam. I will share it at that time. Okay? Okay guys, then if you have any questions, please reach out to me. I will be more than happy to help you. Okay, and all the recordings, everything should be uploaded at this point. So in case you want to refer to anything that we did today, you can always do that. Okay, right then, that's about it. I'll see you next week.